Welcome to Iron Financial, the show that forges stronger portfolios. Today, we are putting Tencent Music Entertainment under a full structural integrity test. You see, their latest earnings report just dropped, and frankly, it sent some serious shockwaves through the market. The stock took a pretty significant hit, even though some of the headline numbers looked, well, impressive. So we're here to do what we do best, cut through all that noise, stress test the fundamentals, and figure out if this company is actually building a solid fortress for the future, or if what we're looking at is really just a crumbling facade. Okay, so we're going to run a rigorous 5-point inspection. First, we're tackling the Titan's mixed signals, why the market reacted the way it did. Then, we're going to get our hands dirty and forge into the revenue engine to see where the power's coming from. After that, we'll probe the user foundation, looking for any potential cracks. Then, we'll pull up the analyst's blueprints, see what the outside inspectors are saying. And finally, we'll deliver our verdict. Is it a fortress or is it a facade? Let's get to work. All right, let's just dive right into the core issue here, because this is what has the market so confused. The headlines coming out about TME are, frankly, all over the place. You look at one report and you see real strength, you see powerful growth. But then you look at another one and it's all about a miss on expectations and a stock that's heading south. You know, it's the absolute definition of a mixed signal, and if there's one thing investors absolutely hate, it's uncertainty. Well, the numbers don't lie, so let's start there. The top line, that is a pillar of strength. In the fourth quarter, revenue hit 8.64 billion Chinese yuan. That's a really powerful 15.9% year-over-year increase, and it comfortably surpassed what the analysts were estimating. You gotta understand, in a tough global market, that kind of top-line growth is a solid beat. It's a clear indicator of momentum. But hold on, it's never just about the top line, is it? I mean, the market saw that revenue beat, sure, but what it really zeroed in on was that earnings miss you see on the right. The adjusted earnings per ADS, that's the American Depository Share, how it trades in the US, it came in at 1.41 RMB. The consensus, what the street was looking for, was 1.54 RMB. That's not a small miss, it's a clear miss. And what happened right after? The stock dropped. That tells me the market is nervous. A beat on revenue doesn't mean a thing if you can't carry that profit down to the bottom line efficiently. Exactly. That is the central question we have to answer today. Is this a company that's firing on all cylinders, but maybe just struggling with some cost control issues or had a one-time expense throw things off? Or, and this is the big fear, is this impressive revenue growth just masking deeper, more fundamental problems under the surface? I mean, that's the crucial point we have to hammer out. Are we looking at a skyscraper that's still under construction, with some dust and debris that just needs to be cleaned up? Or is the market right to be hesitant about what look like real, genuine stress fractures in the framework? All right, let's pop the hood. It's time to inspect the main load-bearing beams of this entire structure, the revenue streams. If you want to understand a company's real strength, you have to follow the money. So let's forget the market noise, forget the sentiment for just a second, and look at where the cash is actually being generated. First up, that headline number we already touched on. Total revenue growth of 15.9% year-over-year for the fourth quarter. Now, let's be absolutely clear. In this global environment, any company putting up double-digit growth is making a powerful statement. This isn't a small feat. This is the overall output of the entire machine, and from this angle, it's running strong. Now let's drill down a layer deeper. The core of their business, right? The online music services segment, this is where the real heavy lifting happens. And revenue there surged an incredible 21.7%. This is not a side business. This is the engine room. And you'll notice it's accelerating even faster than the company as a whole. That means the most important part of their business is actually getting stronger and stronger. And this right here. This brilliantly illustrates their diversification strategy. Take a look at the revenue from services other than just plain subscriptions. We're talking about things like live performances, advertising, merchandise, a massive 40.8% year-over-year jump. This shows they're finding new and very effective ways to monetize their platform. They're turning it from a simple music app into a multifaceted entertainment powerhouse. Okay, those are impressive growth numbers, I'll definitely give you that. But this table here tells a more nuanced and, I think, a potentially worrying story. That explosive non-subscription growth, it's carrying a lot of weight. Now, guide your eyes down to that bottom line in the table. Social entertainment revenue is down 5.2%. This was once a huge part of their business model. So my question is, are they just shifting money from a failing division to prop up another one? Or is this really sustainable organic growth? To me, it kind of looks like one part of the structure is being dismantled just to reinforce another. That's not a problem. It's a strategic demolition. They are deliberately and wisely de-emphasizing the lower margin, more volatile social entertainment business to focus on higher value streams. And the proof is right there in the margins. The company's gross margin expanded to 44.7%, up from 43.6% a year ago. That's not a sign of weakness. That's a sign of disciplined, smart execution. They are actively choosing profit over empty revenue. Revenue and margins are one thing. Fine. But a platform is absolutely nothing without its users. And this is where I see the biggest potential weakness in this entire structure. We need to go below the surface now and inspect the very foundation itself. Are more people showing up to the party, or are they leaving? Because if the foundation is eroding, the whole thing will eventually collapse, and it won't matter how shiny those revenue numbers look today. And here it is, plain as day. The headline user number, that first bar for monthly active users, shows a drop. MAUs fell by 5% year over year. To put that in perspective, that's a decline from 556 million people down to 528 million. That's 28 million people who are no longer using the platform. You cannot build a fortress on a shrinking plot of land. How is that not a major, major structural red flag? Because you're looking at the wrong metric. This isn't about the size of the crowd, it's about the quality of the audience. Think of it as a controlled demolition. They're deliberately shedding the low-value, non-paying users who drain resources and don't contribute to the bottom line. They're clearing them out to focus on a more profitable, more engaged core. Now look at that second bar. Paying users are up 5.3% to 127.4 million. They're reinforcing the foundation with better materials, customers who actually value the service enough to pay for it. This isn't an accident, it's a deliberate and, I would argue, brilliant strategy. And here it is. This is the knockout punch. This number right here validates the entire strategy we were just talking about. We're looking at average revenue per paying user, or ARPPU. Basically, it's how much money they make from each subscriber every single month. And it grew by a very, very healthy 7.2% year over year. So you're saying not only are there more people paying, but each one of those people is spending more money? Exactly. They are successfully converting users to their premium tiers, like their SVIP or Super VIP, which now has a subscriber base of over 20 million people. This is the holy grail for any subscription business. It shows you have pricing power and a sticky user base that loves your product. You have to remember, in the brutal streaming wars, the winner won't be the one with the most free users, it'll be the one with the most profitable users. They're not trying to build a public park for everyone. They're building a members-only club, and that's a much, much better business model. Fine. The internal numbers, when you frame them that way, do show a clear strategy. I'll give you that. But we're Iron Financial. We don't just take the company's word for it, and we certainly don't just rely on our own inspection. We need to see the third-party assessments. What does the rest of the street think about this structure? What are the other blueprints saying? Let's take a look. All right, let's look at the Smart Karma Smart Scores. These give us a quantitative, unbiased look at the company's overall health. It's a powerful blueprint. You see a perfect 5 out of 5 on growth. The system agrees. The engine is roaring. Then you have strong scores, 4 out of 5, on value, on dividend, and on resilience. This is the blueprint for a company with a solid financial core, good returns for investors, and the structural ability to withstand market turbulence. But you can't just cherry-pick the high scores. Look at that momentum score down there in the table, a dismal 2 out of 5. That aligns perfectly with the stock dropping after the earnings call. It tells me that while the long-term structure might be sound on paper, the short-term market sentiment is a real, significant headwind. The street is not buying the story just yet. You can build the strongest, most beautiful skyscraper in the world, but if no one wants to move in, you have a very expensive problem. See, you're focused on short-term noise. We're focused on long-term value. That low momentum score you're pointing to, that's an opportunity, not just a risk. For a true value investor, that's a signal to look closer, to dig deeper. And when you do, you see what analysts like Raj saw from Smart Karma are seeing, a potential 70 to 100% medium-term upside. That is not a minor adjustment. That's a forecast for significant value creation, built on the power of compounding earnings. That's exactly the kind of asymmetry we look for. The market's short-term pessimism could be the perfect entry point for a massive long-term win. But even the bulls, the people who are most optimistic, acknowledge the risks. You have to read the fine print on the blueprint. Those same analyst reports that praise the long-term potential also point to very real, very significant challenges. Regulatory risk in China is a constant variable that can change overnight, and a huge part of that non-subscription growth came from live concerts. Was that just a one-time post-pandemic revenge spending surge, or can they actually sustain it? And that strategic pivot we talked about, it requires flawless execution. One little misstep, and the whole quality over quantity strategy falls apart. These aren't just cosmetic cracks. These are potential fault lines that need to be monitored constantly. All right, we've done the work. We've stress-tested the revenue engine, we've probed the user foundation for weaknesses, and we've reviewed the external blueprints from top to bottom. It is time for the final inspection. So let's stack up the pillars of strength against the potential weaknesses and deliver the iron financial verdict. Is this a structure you want in your portfolio, or is it a teardown? The case for this being a fortress is built on solid steel. We have powerful double-digit revenue growth and, more importantly, expanding margins, which proves that profitability is their top priority. The user base is getting stronger and more valuable, not weaker. They are sitting on an absolute mountain of cash, over $5.4 billion US. And crucially, management just initiated a significant annual dividend. Now that is management signaling extreme confidence in future cash flow. You don't start handing out hundreds of millions of dollars to your shareholders if you think the building is about to fall down. This is a sign of a robust, confident, and durable structure. But you cannot ignore the issues the market is clearly seeing. The EPS miss is what spooked investors in the first place, and it's a valid concern about their execution. That shrinking overall user base, while you call it strategic, is still a risk. What happens if they can't continue to convert those free users to paying tiers at this high rate? That foundation starts to look shaky again. And that low momentum score shows that the market, the people with real money on the line, just isn't convinced yet. It's a show-me story, and so far, they haven't quite shown enough to silence the doubters. So the final verdict. After our full inspection, the evidence points overwhelmingly to a solid foundation. The core business is accelerating, the profit margins are expanding, and management is returning cash to shareholders. The strategy of focusing on high-value, paying users is not just some theory on a slide. The data proves it is working. The core structure is absolutely sound, but the cracks are real. I'd call them cosmetic for now, but they need to be sealed up. The EPS miss and the MAU decline are not just noise. They're legitimate data points that the market is watching very closely. The company is in a critical transition period, and the market is right to be in show-me mode. The foundation is there, I agree. But the market wants to see a few more floors built without any issues before they're willing to pay a premium for this real estate. So, the crucial point for your portfolio is this. TME's structural integrity test reveals a fundamentally strong company with a clear, profitable strategy for the future. The market is currently fixated on the cosmetic issues, the EPS miss, the MAU decline, and that is creating a potential disconnect between the current stock price and the long-term intrinsic value of this business. The question you have to ask yourself is whether you have the discipline to invest in a solid structure while everyone else is distracted by the paint job. That's the analysis from Iron Financial. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.